Okay, let's get into it. Welcome to the deep dive. Today we're looking at a technical analysis tool, one you see in the stock market, but it has links to nature. We're talking about Fibonacci retracement. Now, our source for this is a YouTube transcript, really focused on explaining this specific tool, keeping it simple. So our mission for you listening is to unpack that, cut through any jargon, pull out the really key stuff from the source. We want you to get what Fibonacci retracement is, how the source says to use it, and, why a trader might even bother with it. It's like a shortcut, really, getting the core value without you having to sift through tons of info.
Exactly. The source presents it as pretty straightforward, and we'll stick right to what that material tells us.
So yeah, let's dive in. What exactly is this Fibonacci retracement?
Right, it's got that name, doesn't it? It sounds a bit technical, maybe a bit mathematical. And the source connects it to patterns in nature. That seems, well, interesting for stocks. Where we start? Good question. Let's break down the name like the source does.
Right.
First part, Fibonacci. This comes from, well, a person known for identifying certain numbers, certain ratios. And these ratios, they just pop up all over nature. Think spiral shells, flower petals, that sort of thing. The idea here, based on the source, is that maybe, just maybe, these natural patterns also show up somehow in how market prices move.
Okay, Fibonacci, nature's patterns. What about the retracement part?
Right, retracement. If you watch prices, they don't just shoot straight up or straight down, do they? Usually in an uptrend, a stock goes up, then kind of pulls back a bit, retraces, before maybe heading up again. And in a downtrend, it drops, then maybe bounces up a little again, retraces before potentially falling more. That temporary move against the main trend, that's what we mean by retracement.
Ah, okay, the pullback or the bounce against the main direction.
Exactly. So Fibonacci retracement, putting it together, is this tool that uses those specific Fibonacci ratios to pinpoint potential price levels where that retracement, that pullback or bounce, might actually stop. And then, crucially, where the original trend might kick back in.
Got it. So using these natural ratios to guess how far a price might pull back inside a trend, why is that helpful? Why would knowing these potential turning points matter to someone trading?
Well, the main purpose, according to the source, is all about finding important support and resistance areas, potential zones.
Support and resistance. Okay. How does that work in practice?
So think about an uptrend. Price is mostly going up, but it dips down temporarily. That's the retracement, right?
Yeah.
The Fibonacci levels that appear below the high point could act as potential support. These are levels where buyers might think, okay, good price, step in, stop the dip, and push the price back up, continuing the trend. So it could help you spot a potential buying chance if you maybe missed the first part of the rise.
Makes sense. And the opposite for a downtrend.
Precisely. In a downtrend, price is generally falling, but it has these little rallies, these upward retracements. The Fibonacci levels appearing above the low point can act as potential resistance. These are levels where sellers might come back in strong, stop the rally, and push the price back down, continuing the downtrend. This could highlight, possible entry points if you're looking to short the stock. Maybe you missed the initial drop.
So for you, the listener, it's really about having a structured method to look for these specific price points where a temporary move might end and the main trend could take over again, offering potential trade entries or exits. Now, plotting this, the source mentioned people get confused about where to start and stop drawing the tool.
Yes, that's super important. And the source lays out clear rules. First step, you've got to identify a definite trend. Is the price generally moving up or generally moving down on the time frame you're looking at? You need that clear direction first.
Okay, find a trend, then what?
Then, within that specific trend move you're analyzing, you pinpoint the absolute highest price reached and the absolute lowest price reached. And the source is specific here used the very tips of the candle shadows, the wicks, to get those exact high and low points.
The wicks, not the candle bodies. Got it. And how you draw it depends on the trend.
Exactly right. This is the key plotting rule from the source. If it's a downtrend price fell from a high point down to a low point, you draw the tool starting from the high point, click and drag down to the low point, high to low. If it's an uptrend price rose from a low point up to a high point, you do the opposite. You draw from the low point, click and drag up to the high point, low to high.
Okay, direction matters. High to low for down, low to high for up, using those wicks. So once you've plotted it correctly, what are the actual numbers, the percentage levels that show up on the chart?
Right, once you set those high and low points, the tool automatically draws these horizontal lines across your chart. These lines represent percentage retracements of that total move you just measured. The key levels the source highlights are 23.6%, that's 0.236, then 38.2% or 0.382, 50%, 0.50, just a halfway mark, 61.8%, 0.618, and finally 78.6%, or 0.786. And the source specifically mentions that 38.2 and 61.8% levels, those are often called the golden ratios, ties back to that nature connection again. Of course, you also have 0% and 100%, which are just your start and end points, the high and low you picked.
Those are very specific numbers. So you've got these lines, 23.6, 38.2, 50, 61.8, 78.6. The price starts retracing, moving back towards these lines. What does the source say you do then? How do you interpret what happens?
This is the core of using it. You watch for a reaction, or maybe think of it as a rejection right at these levels. The source showed examples of this.
A reaction, like the price hits the line and bounces off?
Pretty much. Let's take the downtrend examples from the source, like Reliance or Nifty. They plotted high to low. Then the price starts bouncing up from the low point, that's the upward retracement. As it hits, say, the 38.2% level, the source pointed out how price stalled there. It acted as resistance. Price struggled to go higher, maybe turned back down. In another case, they showed resistance forming around the 23.6% level.
Okay, so resistance on the way up in a downtrend.
And the flip side for an uptrend. They showed Nifty in an uptrend plotted low to high. Then the price starts falling back, retracing downwards from its peak. It comes down towards, say, the 50% level. The source highlighted a case where the price hit that 50% level and reacted positively, found support. It bounced off that level and started moving up again. They also mentioned sort of generally that this 50% level seems to be a pretty common retracement target for stocks. And they noted reactions near 38.2% and 23.6% too in uptrend pullbacks. Yeah. So basically, if the price hits a fib level and then clearly reverses direction, that level has acted as support if price bounced up, or resistance if price turned down. That reaction is the confirmation you're looking for, according to the source.
And that reaction is the potential signal. The signal that the temporary pullback might be done and the main trend could be resuming. That's where the trading opportunity might lie.
You mentioned the source used specific stock charts.
Yes, they did. They walked through applying it to Reliance in a downtrend, showed drawing high to low, and pointed out where price met resistance near that 23.6% line.
Okay.
And they used Nifty quite a bit. Showed a downtrend example, high to low plot, and highlighted reactions at 23.6% and 38.2% resistance during the bounces. Then another Nifty chart, this time an uptrend, plotting low to high. They showed support reactions around the 50% level and also mentioned 38.2% and 23.6% playing a role as the price pulled back before moving higher.
So multiple examples. Yeah, and they also quickly mentioned applying the same logic to HDFC Bank and Bank Nifty charts, although the detailed walkthrough is focused on Reliance and Nifty. One interesting practical tip they shared from looking at these examples was that applying the Fibonacci tool seems to work better, the levels seem more respected, on longer time frames, daily charts, weekly charts, rather than very short-term ones.
That's a good insight. Longer time frames might give stronger signals. Now, this whole thing is based on the idea that the price is just retracing within an existing trend. But trends don't last forever. What if the price retraces and just keeps going, blasts right through these levels? Does the source give a point where you say, okay, this isn't just a retracement anymore, the trend might be changing?
Yes, absolutely. That's a crucial caveat they included. Fibonacci retracement is meant for analyzing pullbacks while the main trend is still valid.
Right.
The source gives a specific rule of thumb for this. They state that if the price retraces beyond the 78.6% level, that 0.786 line, that's a strong signal that the original trend might actually be finished, done. At that point, the move isn't just a pullback anymore, it's potentially the start of a whole new trend in the opposite direction. So if price breaks convincingly past 78.6%, the course basically says your original trade idea based on that trend and retracement is probably invalid. That level is their sort of line in the sand.
Wow, okay, so 78.6% is the line. If price crosses that, you really need to rethink the whole trend picture, according to the source. That's critical context. Did the source mention looking at anything else besides just the price chart and these fib levels? Any other indicators, maybe?
They did bring up one other tool, very briefly, more as a complementary piece of information. It was the put-call ratio, the PCR.
Ah, the PCR. What did they say about using that?
It was quite a simple interpretation they offered. They basically said, if the PCR is less than 1, the odds are maybe a bit higher that the price could go down. And if the PCR value changes significantly, that might suggest the price could be about to bounce.
Interesting. Did they say where they get this PCR data?
They mentioned using something called Autotrender software for their PCR analysis, but they didn't really go into any detail about the software itself, just gave that basic interpretation of the ratio.
Okay, so PCR was just a quick mention, another potential input with a very specific, simple guideline provided by the source. All right, let's try to wrap this up then. This deep dive into the source on a Fibonacci retracement. We've covered what it is, basically using these math ratios found in nature somehow to look for potential turning points inside a market trend. We learned the really vital part about plotting it. High to low for downtrends, low to high for uptrends, always using the wicks. We identified those key percentage levels it throws up: 23.6, 38.2, the halfway 50, 61.8. Those last two being the golden ratios, and that crucial 78.6. And the idea is to watch price reacting at these levels, bouncing off or stalling as potential signs of support or resistance.
Exactly. And we touched on how the source used examples like Reliance and Nifty to show this in action, plus that useful tip about longer time frames potentially being more reliable. And critically, that 78.6% level acting as a kind of warning signal if price goes beyond that. The original trend might be suspect. Oh, and the brief mention of PCR is maybe another data point with the source's specific take on it.
Yeah, it definitely gives a clear structure, a framework for looking for those pauses or turns within a larger price move.
It does. And look, no tool is a crystal ball, right?
Yeah.
But understanding frameworks like Fibonacci retracement, which kind of fascinatingly draws on these patterns seen everywhere from, pine cones to galaxies,
Yeah.
it offers a structured way to think about potential price behavior within the market's flow. It gives you specific levels to watch rather than just guessing.
It really is a fascinating concept when you put it like that. Thanks for joining us on this deep dive.
My pleasure. And maybe a final thought for you, the listener, based on the source's core idea. Isn't it interesting that these very precise mathematical ratios observed in the natural world might actually provide a useful lens for looking at stock market movements, something driven by, complex human behavior and economics? Does that hint at some deeper underlying patterns in how markets or maybe even crowds behave? Or is it simply a framework that happens to resonate, something traders have found consistently useful over time? Definitely something to think about next time you see those lines on a chart.